Hello and welcome to iTradeAIMS.net. This is Imi, and today I'm going to show you the KC123 method, how to trade the KC123 method step by step. So let's begin. So the KC is a famous indicator, not something that I created. It's already been there. It's been tested, statistically proven. It's Keltner channels, but the parameters can be changed, so the parameters that we use are slightly different. It is a simple trend following indicator, but the difference with this is that it has a built-in volatility factor inside it. Now, it is used for trend trading, and trend trading is a highly profitable strategy. The best entry method for entering into a trend is the pullback method. If you want to watch more about pullback method, I have quite a lot of videos on this blog to see, or the YouTube channel, so please check them out. I'm not going to explain the pullback method in this video, but you can check them. So often beginners do not know when to get in and when to stay out of a trend, and they don't know how to identify the trend correctly. This indicator and the 3 rules that I'm going to give you will help you actually get into a trend on a pullback, and you'll have the best entry method. I will also teach you where to put your stop loss and when to take your profits. And that is where the KC can really help. So there is a separate video on what is the KC in more detail, like how is it plotted, but I will quickly show you. It's not that difficult anyway in the next few slides. So the KC will keep you out of the market when it's choppy and it's range bound, and following the 3 simple rules, actually it's just 1, 2, 3 rules, right? You will only take trades, or the KC will get you involved into the market only when it's really moving and it's most optimum, and it's statistically proven to have an edge. Right, so what's next? So the KC is plotted using what you see on the chart. I've just randomly selected yesterday's M1 chart. This was not even high volatility period, it was low volatility period, and that's why I've chosen this chart from yesterday, because it's not one of the most beautiful chart, right? KC is, what we have done is that we calculated using the 20 EMA, and the dotted lines are the upper and the lower bands. They are calculated 2 ATR away. ATR is average true range. So basically a true range is if you measure or calculate the last 20 candles, and you calculate the high and the low of the candle, and then you plot it 20 times, and then you take its average and then multiply it by 2, it will give you that line, and multiply it by -2, then it will give you the lower line. Why is it this? Well, the market moves in waves, as we know, and it oscillates between a certain point. So even if it's going down, it's going to keep going up and down and up and down. What we have found, well, not us, but the statisticians and the people who have done actually the work on this, like people like Adam Grimes and them, market would usually go 2 ATRs and then come back, and then go back there and then come back. So that's kind of how it moves, and this indicator then gets you into in the most optimum spot where you can get in and get the most profit. So this is the upper band set at 2 ATR, and this one, the below, is the lower band set at a distance of 2 ATR distance away from the midline, which is the 20 EMA. So the upper band here and the lower band here and the center line. So what is the center line? The center line is basically the average of the last 20 bars. In this case, we see price going below the center line. It goes out of the band, and then it starts to retrace back, creating a pullback, and then the resumption of trend, another pullback, and resumption of trend. So here are the rules then. At point 1, you have your breakout move, and this is where you start waiting for a pullback. So when price goes on the other side of the 20 EMA, and it starts to go towards the so at this point you're not in a trade, right? You're waiting for your signal. Price pokes. This is the first rule. price must poke the outer band. In this case, it's poked below the lower band, so you'll be looking for shorts. It pokes out, and that's your point 1. At point 2, this is now your entry zone, because it has pulled back and it's come over here, but you can still see that it's, you know, bullish candles and bullish candles. Only up to this candle here is when you see your first kind of a doji candle. And I will show you how you can enter using different methods on this. But for now, just we need to know that this is your point 1. The price goes out or pokes or just touches. In this case, it's actually gone out of it and then it comes back to the center. That's where your entry zone is. We have entry indicators for this as well. I'm not going to show them in this video, but they have their own videos available, and the whole courses are available for those who are members. But if you're not, you can just search them on the blog. One of the entry method is the cherry. There's a seed method. This would be a seed entry here. And then we have the new entry signal, the banana, which I really like. There's a separate article on the blog about the banana, so please do check it out. There's a small video about it as well. Right. So there's always the question of where would I enter and where would I put my stop loss, and those are the most important questions when you are trading. So for this method, stop loss should be calculated based on the outer band, and I will tell you why it's the most optimum level is the outer band, is because when a pullback is happening, you don't know when it's going to end, and sometimes the pullback can be complex. So we have found that if you have your initial stop loss all the way up there, it will increase your win rate. So in this case, the upper band is up there. This would be your 2 ATR stop loss, and that would be your 1R, which is 1 unit risk, 1R risk, all right? It's actually 1R, 1 unit of risk. So the point 3 is when price actually starts to resume in the direction of the trend. See, trend, pullback, resumption. Point 3 is your spot where you will start thinking of exiting, because this is your first target. Here price has reached the previous lows, so you can see, let's move that a bit. We have price reaching previous lows, giving you opportunity to actually take 1R, 1 unit of, or 2 ATR. So there's a 2 ATR move. So if you entered here, price move 2 ATR in your favor, you can take your profits, and that would be your 1R profit. You can, if you like, you can sell or close half here, right? I will cover it in this video a little bit later in different slides as well, why that can be useful. Or you can actually exit all. So if you sold half here, then you're bringing your stop loss there, in which case you will be closed, the rest of the position will be closed out at break even. Or another way of doing it is that, so if you enter here and you close up here, you bring your stop loss above that swing high. So then if price was to come and hit that level, then you have a small loser and 0.5% winner, or half R winner, which will still be a winner, but it will allow you to stay in the trade longer. What I would do is that if I close half here and my stop loss is there, I most probably get out. And because this has become into a new setup, 1, 2, then I will get back in there again. Right. Okay, so now let's use a different chart. So this is DAX on the 5-minute chart, 30th of June, and this is the London session. So price went up first, poked up there, hit those highs, and it could not clear those highs. Let's mark that. After that, it started to come down. I felt like it was a pullback for the move up, but as soon as this low was broken, you know that things are changing. But for us, at point 1 is where the magic happened. Hold on, let me just go to the previous slide. Yes, I forgot to mention this, that if you close half here and leave your stop loss at the original and you let it run, In that case, you'll be able to either add on here and take more trades, and add on here, take more trades, and you'll be able to, you can, if you want, you know, this is what I call the swing trading on the 5-minute or the 1-minute chart, is you will trade the entire sequence down there, and if you trail the boxes, if you have the ATM, you can just hit the T fractal button, then it would have trailed your stop loss and you would get out here, which would increase your profits. So back to this slide. So over here you have your point 1. That's your rule number 1. It must poke out. So here was your rule number 1. It poked out. When you were looking for a pullback, it did not really pull back. It actually went all the way back. So we don't want 100% pullback. This is actually a reversal. It just changed. We have 4 trend candles and created point 1. When price came back to the center, you have a bull candle suggesting that probably price is trying to go back up, but then the next one is an inside candle and the next one is still an inside there. So it's kind of a bull candle, but I think I'll call it a doji here. And then you have a bear candle. This is the candle that will always get me short. So if I see this candle, I will put a pending order below this, and my stop loss will be, and that is a very important question, where will be my stop loss? So we will explore that in a bit. So let me read that to you. At point 1, you see a new lower low. That's the important bit. See, it's a new lower low, at least for this session, and price has poked below the KC lower band. So that's your rule number 1. This must happen. This indicates that the market has shown a strong bear move which exceeded or matched around 2 ATR. So it moved 2 ATR down. At point 2, we now have 50% pullback. So if you look at this bit, oh, not that. So that's the move down, and pullback up is about half of that. So that's about, 50% pullback. But that's not important. What is important is that it's actually come back to the center line, and then it started going sideways. It did not go all the way up. If it did go all the way up, then the setup would be invalid. So it poses there, giving us opportunity to go short. And we see a couple of doji candles and a bear candle, and we go short here. Now, the question is, where should you put your stop loss? Should it be 0.7 or should it be 0.8? 0.7 is the high of the session, and it's the high of the London Open as well and the overnight range. And 0.8 is actually the KC upper band. So where should you put your stop loss? Take a moment. 0.7 is actually the best spot to put your stop loss, because that is where this is the start of the leg down, and this is the rejection. I will not go into detail, but I know that at this time, if you had done your analysis on the hourly chart, you would have identified a strong support level there as well. And at the same time, it was the support of the overnight range as well. We can see that there's a rejection wick up there. So you know that this is where price was rejected. If price was to go above there, there's going to be a breakout situation. So you'll be proven wrong. So that was a good spot. But at the same time, number 8, this is the KC band. This is 2 ATR, so that's also very good. But in this case, it's very close to that. So we will actually put stop loss above there. If prices go above there, you're definitely proven wrong. Now, 0.7 is a wider stop loss location. But don't worry, because if you think it's too far, you need to know that professional traders will always will never, not always, will never let prices hit their wider stop loss. The reason it's wider is because when you make your entry here, you still don't know that the pullback has ended. So pullback will probably come a little bit further up, right? But if there was a strong bullish candle going up, even before closing, we would know that price is going against us. We will not let the stop loss be hit. We'll actually take our loss and get out. But pullbacks can sometimes be complex, like 1, 2, 3. Well, this is not really a pullback, it was happening. That's a different topic anyway. Sometimes it can be complex, and then keeping a wider stop loss gives you the option to actually stay in it a bit longer. The market will tell you well in advance whether you should get out. Point 8 is also a wide stop loss, and it's pretty good. Using this stop loss will keep you in trades longer as they develop, and this will increase your win rate. So sometimes you have pullbacks like this, 1, 2, 3, like this is a simple pullback. But other times you could have a pullback that kind of goes like this, even a few more. But as long as it kind of stays in a channel like so, creating a bear flag for you, you know, like if price was to come around here and then went up like so, and like this, and then like that. So it's gone on the other side of the central line, but it's still not showing any sign of a bull trend. So by keeping your stop loss above some up there, you won't exit prematurely. Like for example, if you were looking for a pullback over here and then you saw this huge candle, you know immediately that what you were looking for is not there. I mean, in this case, it was proven to us before because you have a consolidation going on here. It's consolidating here near the lower bands, and it broke above it, and then it broke above that again. So it's definitely, and that's why these 4, 5, and 6 are marked, because I'm going to talk about exits, and this is where they will come in handy. So again, like the previous slide, the other example that we used on the M1, this is where you will, point 3, which is this, is where prices have now come to the previous lows, and this is where you can, take your profits. But you can see that had you taken all your profits, you would have actually given away or not taken advantage of this really major strong move. It's a breakout phase, and so there is a remedy for that, because we don't want to miss out on opportunities like this. There are 2 ways to actually then take advantage of this. There is no need to worry because we have a solution. Well, number 1 is you can either close half over here. Compared to the previous example, prices kind of slowed down around that level, but this time there's a strong breakout candle that actually closed outside. And that's why it's best not to have target points. I mean, in the first 15 to 20 trades that you want to take, you can actually have a strong, you can just put a target point there. But after 30 or 40 trades that you've taken, you want to go further, it would be ideal to actually have target 1 here, maybe close half, bring your stop loss. If stop loss was started here or number 7 or 8, you can then put it above number 2 after these 2 candles. And when it breaks out, let the rest of it run. That would be one way of doing it. Now, the other way would be that if you got out and then you saw the trend candles, then there's another way of getting in, which is the trend candle entry. Now, I cannot cover that in this because that's an entry mechanism of its own, but there is a video on this blog. If you search it, you will find how to trade. It's a 1-hour video that I did with Sam, how to trade the trend candles. And using this candle, that's one of those candles, you'll be able to get back in. And the next question is where to exit if you caught the runner. So for example, if you were in there or you got back in using the trend candle, where would you exit? And that's where I've marked point 4, 5, and 6. These are your options. And yet there is another option, which is to trade candles. And the question will be, when do you start trading candles? So I will tell you that in a bit. But before that, why number 4? Because market has been in a breakout phase. Whenever the market is in a breakout phase, it will be out of the ATR bands. And it will have most it won't have, like in this case, you will hardly ever see a bear candle that breaks the high, or maybe one candle that breaks the high but then resumes. And that's the breakout phase, mostly bear candles. There's some, trend candle, doji, 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 and none of the candles have broken the high, so you could easily have trailed it. But once that ended, you can see the market started going sideways. As soon as you have this really strong bull candle here, after that, none of the candle actually broke the lows, and it just went sideways. So this was a range. I would easily put my stop loss above the range. And when it goes out, if I had my stop loss up there and then I saw this candle, I would get out because this is a nice strong bull candle. If I still waited, then I have these two candles creating a box high, a fractal box high. If you use the AIMS box indicator, you would know that there would be a box there. You'll put your stop loss there. The latest you should exit would be this one, because this is a very, very strong bull trend candle. And then as soon as this closes, you're out of this trade. Now let's discuss the trailing candles. Now the trail candles gets activated when you see a free bar. So what is a free bar? When a candle, when price goes out of the band, so in this case it's a bear trend, so out of the lower band. When a candle is completely out of the band, like in this case the high and the low, and the low and high, all of it is entirely out of the band. It's touching a little bit, but I will class this as a free candle. If not that, this definitely is a free candle. This is a free candle. This is a free candle all the way, all the way. These are all until this candle that closed inside. All of these were free candles. So as soon as you see free candles, or you see 3 or 4 trend candles, start trailing the stop loss. And trailing stop loss, you can either trail the last close candle or a lagging one behind. So when this one closes, put stop loss there. When this one closes, put stop loss there. When this closes, put stop loss one candle behind. And then when it kind of tapers around here, best to keep stop loss up there. And then when you have another breakout, then put stop loss there as soon as it starts coming. So around here, you will have your stop loss there. Around here, because these two are the same, you put your stop loss there. After this candle, your stop loss will be there. Now, when this candle happens, because this candle does not have a high higher than that, your stop loss will still stay there. Now, after this candle, you still don't have a higher one, so stop loss still stay there. And after this candle, now you have this candle is your high, so you put your stop loss there. This candle went further down, so now you have this one here. So because it's creating a box, I would just keep my stop loss up there at this level, and then it gets hit. So that's how you can do that. Otherwise, you can just trail the candles, keep going down. In that case, this candle will get you out. And so that is how you trade. We have discussed short trades. In this example, the buy trades are literally just vertically flip the charts and follow the same exact rules. Instead of highs, the price will be going down, the candle will be white, and that's how it is. And before I go, let's talk about this. So this is not a KC123 entry, but this is what is called the reversal entry, and this deserves a video of its own, and we will talk about it there. So thank you very much for watching. I hope you like this video. If I put it on YouTube, please hit the like button and subscribe to the channel. If you're watching it on the blog, stay subscribed to the blog and check out in the future. There will be more videos about this, and I hope you like this. Please leave me a comment. Thank you.